Well, hello and welcome back to Principles of Accounting 2. I am still your host, Dr. B. We are in our final session together. Uh, First and foremost, I want to thank all of you for your very hard work that you've had to endure over the past 7 weeks, especially dealing with me. I know I can be a handful sometimes, but I do appreciate that. I sincerely appreciate all of your efforts in the course. It means a lot to me, and I'm glad to see you all learning a few tricks of the trade, if you will, in business through this course. And hopefully, you'll be able to apply some of the stuff that you in your lives at some point. Uh, it's always that thing. You never know you're going to use it until you use it, right? So hopefully you get to use some of this stuff um, in your careers. So again, thank you so much for a wonderful past 7 weeks together. It's been an absolute pleasure and an honor for me to be your professor. So this is our final lecture together. Let's talk about capital budgeting and investment analysis first, and then we will do a review for the final exam. And I'll do a couple of housekeeping notes. So let's do the housekeeping notes first, and then I'll jump into this. Quickly in a classroom, this is the final lecture, right? So you can find this in week 7, chapter 26. You have your PowerPoint, the exercises, and of course the quiz that's due on Sunday night. Also, due this Sunday night, if for whatever reason you are late with anything over the past few weeks, you are still, for whatever reason, late with the stuff from last week, for example, or the week before even, all of your remaining work must be submitted by this Sunday night. I cannot accept anything past this Sunday night. So if for whatever reason you're late with chapter 25, 24, 23, 22, homework assignments, quizzes, whatever, that must, and I repeat, absolutely must be completed by this Sunday night. No exceptions. I cannot accept anything past this Sunday night. Am I very clear on this? Do you all understand that? Please. Thank you, Chris. Please, if for whatever reason you're late, I don't care why you're late, just get it done. It has to be done by this Sunday night. I cannot accept it past Sunday night. I apologize, but I just want to make sure I'm very clear on that. Okay, now that my housekeeping notes are done, let's jump into our final discussion, which is on capital budgeting and investment analysis. So, when you hear the word capital budgeting, the term capital budgeting, capital is in reference to long term assets. Capital is in reference to long term assets. We're talking about property, plant, and equipment. Those are your fixed long term assets property, plant, and equipment. We budget for everything, as you know. We talked about budgeting in depth last week. This week we're talking about capital budgeting. Capital budgeting, we're budgeting for the purchase or sale of property, plant, and equipment. We're budgeting for investing into the business to grow the business. So when you hear capital budgeting, think investing in property, plant, and equipment. And of course, we as managers need to analyze our investment decisions by looking back at them and trying to decide whether they're good investments or not. We use a couple of different financial tools to help us to make those decisions. So, one of the things I do as a manager is I look at alternatives, long-term investment decisions when deciding to purchase or sell property, plant, and equipment. Most people don't just purchase the first thing they see. Just because the building's there and available for sale and it's ready to take now doesn't mean you should go and buy it. You need to look at your alternatives. Here's building 1 as an option. Here's building 2 as an option. Here's building 3 as an option. Okay? I got 3 different alternatives to purchase a building. They're in different locations. They all have their pros and cons. So one of the things I do as a manager is I look at all these alternatives and I say, okay, which one is the best choice for me? There's a process that I go through. It's called the capital budgeting process. I talk to my department and plant managers and they submit proposals. They say, okay, these are the buildings we want to purchase. These are the machineries that we want to purchase, etc. Right? And I look at their proposals, their alternatives. I evaluate them in my committee. Then once we've evaluated the proposals, we bring those up to the board of directors of the company, and they vote to approve or deny the capital expenditures. It's a little bit more detailed than that, of course, because there's a whole budget that goes into place. The capital budgeting decisions require careful analysis because they are usually the most difficult and risky decisions that a manager can make. For capital budgeting, a decision is very risky for the 4 following reasons. For 1, the outcome is uncertain. Of course the outcome's uncertain. If I buy that building over there, okay, I make a decision. I got 3 buildings. I select one. I create the budget for it to purchase the building. Okay. If the board of directors approves it, who's to say that I wouldn't utilize that building to its fullest potential? So the outcome is uncertain. I purchase the building. If I don't use that building to its fullest potential, the outcome is uncertain. You see? Capital budgeting is also risky because, number 2, large amounts of money are usually involved. Yeah. When I purchase a building, I'm usually talking hundreds of thousands of dollars, sometimes millions of dollars. Huge amounts of money are at risk. Okay. If that decision to purchase that building doesn't work out, I could have just lost $1 million for the company. Right? So a large amount of money involved. Also, because there's a large amount of money involved, I got to get that money somehow. Bank loans, bonds, issue more stock. I got to get that money, right? How do you get money? You take out a bank loan. You issue some bonds. You issue some stock. That's how you raise money. If I purchase the building using that money that I raised, the risk is if I lose that building for whatever reason, I could lose a lot of money, right? And there's a lot of money tied up in that decision. Risk number 3, investment involves a long-term commitment. Yeah, anytime you buy a building, it's long-term. Don't just buy a building and sell it a few days later when you're running a business. No. Okay? It doesn't work that way. It's a long-term commitment. When I purchased that building, I said, oh, it's a 30-year mortgage. That's long-term commitment, right? 30-year mortgage. Okay? That means I plan to be here for 30 years. The building. So it's a long-term commitment. Number 4, part of the decision-making process is, in my opinion, the riskiest of all. Once you make the decision, it may be difficult or impossible to reverse. You can't just sell the building after you just bought it. Not that easy. Okay? It's not that easy. You can't just make the decision, oh, I purchased the machinery, oh, I don't like it. You can't just return it, especially if it's something huge, right? Not that easy. It's very difficult, or in some cases impossible, to reverse a decision once it's made. So these are the 4 risk components when it comes to capital budgeting decision making. Let's say we make the decision to purchase one out of the 3 buildings. So I select option 2 out of the 3 options, 3 alternatives. Go with alternative number 2. Cost $1.5 million to buy this building. So I need to raise capital. I need to raise my money. I do a mix of bank loans, bonds, and I issue some stock, okay, to raise the cash I need to buy that building, alternative 2. When I buy the building, the first thing I need to do is acquire it. So you need to account for acquiring that building. We call this the initial cash outflow. I need to pay that $1.5 million right away. I purchase it to the seller, right? That's the acquisition cost. So initial cash outflow in year 0, that's me giving cash to the seller for the $1.5 million. We call this year 0. Year 0 because the building's not yet in use. I'm not using it yet. I'm just buying it. So at year 0, there's an initial cash outflow for the acquisition of the building, $1.5 million in my example. I'm going to use that building. That's why we purchase property, plant, and equipment, is to use it. By using the building, it's going to help me to generate cash inflow from sales. Okay? I'm going to use that inside that building. I'm going to put some equipment, some assembly lines, and I'm going to start making inventory. Or I'm going to use it for storing inventory that I'm going to sell. Okay? Or other reasons. But the reason has to be that that building that I'm purchasing, that's going to help me to generate revenue. Let's say you're an auto mechanic. You're buying a new building where you're going to repair the cars. Yeah, obviously that building's going to help you to generate revenue. Same concept applies. So the use of the building. Every year, that building is going to help me to generate cash inflow from my sales. I use the building. Inside the building, I got my machinery, my assembly lines. I'm creating my inventory. I'm selling that inventory. So therefore, the building is helping me to generate cash inflow from the sale of my inventory. So every year, I got sales coming in, my revenue coming in from using that building. So that's cash inflows. So year 1, end of year 1, I'm going to have some cash inflow. End of year 2, some more cash inflow. End of year 3, more cash inflow, etc. Of course, I have cash outflows from the operations. Yeah, absolutely. Cash inflow minus cash outflow equals net cash flow. Remember when we talked about the statement of cash flows a long time ago, back in Principles 1, the statement of cash flows shows you the cash inflow minus the cash outflow equals net cash flow. Okay. That's from using a building. Now, at the end of the building's useful life, I can decide to sell the building. Like, you know what? I used that building for 30 years. I've kept up the maintenance on it, and it was great, and it did what it was supposed to do. So I decided it's time to sell it. Okay, you'll sell the building. It'll probably be less than what you bought it for because it's a factory. It needs a little bit of updating. Nobody wants to buy an outdated factory, so we'll dispose it. You get some proceeds from disposing or selling the building at the end of its useful life to get a little bit more cash inflow. Make sense? But we need a budget for these things. We do that in our decision-making process. One of the ways we do this, decide whether that building is going to be a good investment or not, and is through a process called the payback period. The payback period is very simple. It tells me how quickly I'm going to recover the initial cost. How quickly I'm going to recover the initial cost. That is the payback period. How much time will it take for me to recover my initial investment cost? That's the payback period. How long it takes to recover the initial investment cost, initial investment amount. Calculate the payback period. We take the cost of the initial investment. That's purchase price of the building, $1.5 million in my example. Divided by the annual net cash flows. Remember how cash flow is calculated. It's cash inflow from your sales, your revenue, minus cash outflow from your operations, equals net cash flow. Cash inflow minus cash outflow equals net cash flow. Annual net cash flow very simply means cash inflow minus cash outflow equals the net cash flow for the year. For the year. Okay. Of course, the shorter the payback period, the better. I want to be able to recover my initial investment as quickly as possible. Let's take a look at an example using a piece of machinery. Let's say our company is looking at buying a new piece of machinery. Initial cost is $16,000 to purchase this new piece of machinery. We think it'll last about 8 years. So its useful life is 8 years. At the end of its 8-year life, it'll be worth nothing. So the salvage value will be 0. We think we can produce 30,000 units using this new piece of machinery. We would sell each unit at $30. Okay, so that's good revenue, right? Let's take a look at let's calculate the payback period. Payback period is the cost of the investment divided by annual net cash flow. The cost of the piece of machinery is $16,000. The annual net cash flow is $4,100. Here's how we got $4,100. I want you to understand this part, very important. My calculator, there it is. Okay, here's how we got there. Remember, annual net cash flow. We said that our sales price is $30 a unit, and we're going to make 30,000 units with this piece of machinery. That's $900,000 of revenue. Okay? The $900,000 of revenue divided by the, wait, I'm sorry. I think it's 30,000 total. I think I put too many zeros. I was going to say, that don't make much sense. 30,000 units times the sales price, 900,000. 8 years, that's 112,500 revenues per year, minus our expenses, whatever those might be, gets the net cash flow. The net, so 4,100 in this example, annual net cash flow. We take the cost divided by annual net cash flow to equal the payback period expressed in years. So 16,000 divided by 4,100 is 3.9 years. What that means is I will recover my initial cost of $16,000 in 3.9 years. The question is this a good investment or not? The answer is yeah, probably. The reason why yeah, probably is because 3.9 years is a relatively short amount of time. The shorter, the better. But if you're comparing one piece of machinery to another, then you want to do the same calculation for each piece of machinery before you buy it.
I have a question, Professor.
Asia, please.
So, when we were calculating to get to the $4,100, I wasn't following 100%. I know that you multiplied 30 times 1,000 units because that's the price of the units, and that's the amount of units. So, is that the amount of units for the whole entire 8 years?
Yeah, that's for the whole 8 years.
So once you multiplied and got the 900,000, did you divide it by 8 years?
Yep, and that gave me 115,000 something. But what this part of the question doesn't give us is the expenses. So
Oh, okay.
because remember to get annual net cash flow, we take our cash inflow minus the cash outflow.
Okay, so we wouldn't be able to determine that from just this information alone.
No.
Okay, just making sure.
Yep, no problem. You got it. Good question. Now, I want you to take a look at the difference here also. With cash flow, we know it's not going to be the same every year. What I mean by that is, I'm not going to sell the same amount of units every year. It's going to go up, it's going to go down. The sale price might change over time. So there's two cash flow methods. One's called the even cash flow, and the other one's called uneven. Even means we're going to get the same amount of revenue every single year. It's kind of unrealistic because we know that that's not the case for most businesses. You don't receive the same amount of revenue every single year. It usually goes up or down. So this method I'm about to show you now shows you what it looks like if it's uneven, meaning I get different revenue each year. Let's take a look at the same example. The new piece of machinery costs $16,000. 8 years useful life, salvage value of 0. Take a look on the left column. I got years 0 through 8. Yep. Year 0, we notice that the expected net cash flow is minus 16,000. Why is this? Because at year 0, all I'm doing is I'm buying the machine. I'm not actually making anything yet. How could I? I don't have the machine yet. So year 0, I just bought the machine. Year 1 I made net cash flow of $3,000. Year 2, 4,000. Year 3, 4,000. Year 4, 4,000. Year 5, 5,000. Year 6, 3,000. Year 7, 2,000. Year 8, 2,000. This is obviously just an example, but you notice that the expected net cash flows are different. Yeah, they go up, they go down, whatever. On the right side, we see this one called cumulative net cash flows. What this is we take year 0, minus 16,000. We add in the net cash flows from each year. So end of year 1, we're at minus 13. End of year 2, minus 9. We see we're going up, right? End of year 3, minus 5. End of year 4, minus 1,000. So obviously I broke even, right? 5,000 at the end of year 5. I add that in. That means I have net cash flow of cumulative net cash flow in year 5 of 4,000. Once we went positive, that means that we broke even. We reached the point of our payback period. So payback period using uneven cash flows looks like this. We spread it out using this chart, graph, whatever. 4 years plus $1,000 divided by $5,000 expected cash flow at the end of year 5. Gives me 4.2 years. The reason why we add the $1,000 in is because at the end of year 4, we had minus $1,000 cumulative net cash flow. So that's how we got 4.2. Using the payback period method, it has its strengths and its weaknesses. Use cash flow, not income. That's a strength. And the reason why that's a strength is because we're going to use cash for the capital investment. Yeah? We don't want to use net income. We want to use cash. And this another strength is it's easy to compute, very easy to figure out. A couple of weaknesses, though. It does not reflect the timing of the cash flows. I don't know what I'm going to get and when. Yeah, so it doesn't reflect the timing. It ignores all cash after the point of the recovery. Okay, I don't care what happened in year 5, at the end of year 6. All I know is I recovered my initial investment at 4.2 years. I don't care about what happens after that. So that's a weakness. And it ignores the time value of money. In other words, I'm ignoring interest rates. I'm ignoring anything to do with interest or things along those lines. It's got strengths and weaknesses. There's another method that we can use to compute the investment, whether it's a good investment or not, and this is called the accounting rate of return. The accounting rate of return, you take the annual after-tax net income found on your income statement toward the bottom, divided by your annual average investment. Annual average investment is calculated in 2 ways. One way is through what we call straight line. Take the beginning book value plus the ending book value divided by 2. Remember, book value is the value of your assets. Value of your fixed assets. Sorry. Beginning book value plus ending book value divided by 2. Another way to calculate it is to take the sum of the individual years' book values divided by the number of years of the planned investment, how long you're going to use the asset for. That general case. When comparing the investments with similar lives of risk, we prefer to use the investment with a higher accounting rate of return. The takeaway here is the formula, of course, but when we look at accounting rate of return, we want an investment with a higher accounting rate of return when we're comparing one or the other. Let's look at our piece of machinery. I want to buy a piece of machinery for $16,000. It has an annual after-tax net income of $2,100. At the beginning of its useful life, it's worth $16,000. At the end of its useful life, it's worth nothing. $16,000 beginning book value plus the end of its useful life, 0. Value divided by 2. This gives us an accounting rate of return of 8,000. I'm sorry, average annual investment of 8,000. Annual after tax net income is 2,100 divided by 8,000 gives us an accounting rate of return of 26.25%. This is a good investment. Remember, the higher the accounting rate of return, the better. It's a decent formula, but it has its weaknesses. It ignores time value of money, so it ignores the interest rate. It focuses on net income, not on cash flows. You know, when you're making an investment decision, that could be a risk. And if the income varies each year, the project might appear to be desirable in some years and not in others. Another way of looking at an investment, if it's a good investment or not, is called net present value. Net present value, and we've talked about net present value briefly in the past, it is a financial formula that tells us the value of the asset based on time. Apply to the time value of money formula, the future cash flows, and outflows, so we can make a decision on the project's benefits and costs at a certain point in time. When we calculate the net present value, we look at the discount of the future net cash flows from the investment at the required rate of return. And then we subtract the initial amount invested from the sum of the discounted cash flows. I know it sounds complex. I want you to remember something. Time value of money formulas can be calculated with a financial calculator. Don't just write it out by hand. I promise you'll drive yourself crazy. So use a financial calculator. You can either use a physical one like the one I have in my hand, or you can find one online, or you can use the Excel. Excel has these formulas built in. Notice in the first part we've mentioned the word required rate of return. The required rate of return is also called the hurdle rate. It's typically a cost of capital that the company pays back over time. Think of this as the company's interest rate. Similar. Now, how we find the required rate of return? We usually do it based off of this concept called a chart. See this chart here where it says present value of 1 and 12%. This is how we find required rate of return, just so you know. Let's take a look at our example. Buying a piece of machinery for $16,000, 8 years useful life, 0 salvage value. We have annual net cash inflows of $4,100. that's going to require 12% annual rate of return. Cash flow, net cash flow, times present value of 1 at 12% equals the present value of net cash flows. We add them up for each one. We do the same process for the 8 years to get a total of 20,367. Then the step 2 is to subtract out the initial investment, in this case 16,000, to equal the net present value of 4,367. Now remember what I told you earlier. You can use a financial calculator you find online, or even Excel to calculate net present value. If the net present value is greater than 0, it's a good investment. The decision tree looks like this. Present value of net cash flows minus the amount of the investment equals net present value. If the net present value is greater than 0, then we do the investment. If it's less than 0, we do not invest. We run this to compare different investment opportunities. Straightforward. We can simplify the concept of net present value by looking at the cash flows and the initial investment. The initial investment comes at year 0, which is the initial cash outflow. In our example, it's 16,000 is the purchase price. Every year we have equal cash inflows of $4,100. Years 1 through 8. At the end of year 8, it's worth nothing. We dispose of the piece of equipment. If we add up years 1 through 8, we get $20,367. We subtract the initial investment from that amount to get a net present value of $4,367. All we did is we graphically represented the information that we saw from the earlier table. Just kind of show you what it looks like. Don't worry, I'm not going to have you guys calculating this kind of crazy stuff. I just want you to understand the basic premise when it comes to making investment decisions for the company, when it comes to acquiring property, plant, and equipment. If we add up years 1 through 8, we have a net cash savings of $1.5 million when we go to purchase a piece of CNC machinery. In this example, we have a rate of return of 10%, 1 at 10%, using the annuity table gives us 6.1446. I take my net cash savings times the annuity table amount to get me present value net cash flows, subtract the purchase price of the machinery to get the net present value. All this is doing is showing you the same exact formula using a different piece of machinery. If the net present value is greater than 0, it's a good investment. Here's another example using uneven cash flows. I have cash flows A, B, and C. Projections. This particular project is 3 years. You can see my total net cash flow is 15,000 per year. 15,000. We have a present value. We have an accounting rate of return of 10%. Using the table, 1 at 10%.
Yeah, Professor, not to disturb you, but I just was wondering about that present value of 1 to 10%. How is that determined? On the last one, it was 1 to 12%.
Yeah,
so,
it's based off of these are different examples. So
right.
The last one I showed you, let me go back. This one was 1 at 10%. This one was at 1 at 12%. Here. So the percentage is called the accounting rate of return. Accounting rate of return is kind of like saying the company's interest rate.
Oh, okay. That's what we just calculated before. Okay. I think I get
Exactly.
it.
You got it.
Okay.
So the percentage is going to be different for each company, right? In each example.
Mm-hmm.
But this present value table you see, one at whatever percentage,
Mm-hmm.
that we call it an annuity table. Okay. And so all we're doing is we're taking the cash flow times the annuity uh, to equal the net cash flow, the present value net cash flow.
Okay.
It's the same exact formula, just using different
Mm-hmm.
examples.
Okay.
So looking at this example, it's 1 at 10%. Take the net cash flow times the annuity amount to equal the present value of the net cash flow. Put them all up together. The total minus the initial investment to equal net present value. Now let me ask you, well, the answer is obviously there, but these are three different options, yeah? Option A, oh, I'm sorry, alternatives. Alternative A, alternative B, alternative C. Out of these three alternatives, obviously I would accept either alternative A or alternative B. I would not accept alternative C. The reason for that is because the net present value in alternative C is negative. Remember, the rule is you only accept a project or a proposal if the net present value is greater than zero. If I had to choose between alternative A and B in this example, I would select alternative B because it has the higher net present value. Another method of comparing net present values when they have positive net present values is by using what's called a profitability index. Going back to this slide here, if I'm only looking at projects A and B, because those two proposals have positive net present values, I want to figure out which one's better. As of right now, just looking at this information, yeah, project B is the best option. It has a higher net present value over project A. I want to be sure. The way to be sure is to run what we call a profitability index. Profitability index tells me which of the two projects will be better for me. And to figure this out, we take the present value of net cash flow divided by the investment. So, using the example, looking at the three alternatives, project A, present value is 900,000, project B, 375, project 327, divided by the investment amount. So to find the profitability index, present value net cash flows divided by investment amount. We have to be higher than 1 in order for it to make sense. Anything higher 1 or better is good. Anything below 1 is not good. We can see, as of right now, option 2 has the best profitability index. So I would go with option 2. Another way to think about this, I don't know if your book explains it that way, but another way to think about profitability index, think about like ranking. You're ranking your options. Okay, you're ranking them in the order which uh, greatest to least. Yeah, you're ranking them. Another way of thinking about that. When we invest in property, plant, and equipment as a business to grow the business, there's a lot of constraints that you need to be aware of. Okay, but those constraints have to do with what we call capital rationing. We don't want to spend all of our investment up front. Okay, you want to be careful with your cash. You don't want to just spend it all right away on property, plant, and equipment. You got to be you have to impose restrictions on yourself. So, two forms of rationing capital money. It's called hard rationing, one's called soft. Hard rationing is imposed by external forces. What we mean by that is if interest rates are real high, like they are now in 2022, when interest rates are real high, you're not going to want to borrow a whole lot because the interest rates are high. We call that hard rationing. External forces limiting the investment. The other form is called soft rationing. I'm going to limit myself from spending all of my capital up front. I impose my own limitation on myself. That's called soft rationing. Hard rationing, external forces. Soft rationing, internal forces. One of the last ways that we look at an investment decision, purchase property, plant, and equipment, is called the internal rate of return. We talked about the accounting rate of return. That's very different than the internal rate of return. The internal rate of return looks at the interest rate. Okay. It's two steps. First is we take the present value of the cash inflows minus the initial investment. If it to get it to equal zero. The net present value equals zero, that gives me the internal rate of return. So looking at our earlier another example, different example. A project, useful life 3 years. The initial cost of this project is going to be $12,000. We'll get a net cash inflow of $5,000. So the formula is we take the cost divided by the annual net cash inflows. 12,000 divided by 5,000 is 2.4. 2.4 would be my internal rate of return. Okay, 2.4, I use the annuity index. I look for 2.4 at 3 years. It tells me my discount rate or internal rate of return should be 12%. Just like before, you could use uneven cash flows, internal rate of return to figure out an investment. We take the internal rate of return minus the hurdle rate. Hurdle rate, as I mentioned earlier, is like the accounting rate of return. Yeah. If your internal rate of return is greater than your hurdle rate, we make the investment decision. Internal rate of return minus hurdle rate. If it's greater than zero, we invest. If it's less than zero, we do not invest. This slide kind of shows you the four methods that we just talked about side by side, talking about the strengths and weaknesses, the measurement base, and the measurement unit. This is a good slide to remember. Hint, hint. A good slide to remember. Hint, hint. Okay. Last one I want to talk to you about with capital investing is break even. Break even, very similar to the payback period. We look at the cumulative, right, to find the break even. Break even is where your revenues equal your expenses, remember? It's also where we recover the initial investment. So break even is very similar to the payback period. And we could use a chart to do that, just like we did before. Your zero is the cash outflow for the initial investment, and we start adding in all of the present values, right? Cash flow times present value annuity rate gives us the present value of the cash flow. We keep adding up all the present values of the cash flows until we reach zero. When we reach zero, that's our break-even time. In this example, it's between 5 and 6 years. To compute things like present value and internal rate of return, as I mentioned earlier, you can use a financial calculator, an online financial calculator, or Excel. Excel is pretty easy, okay? All you got to do is put the information into Excel, the cash flows for each year, number of years. You go equals net present value, and then you plug in the formula. It's super easy. I always recommend Excel when you compute those kinds of things, just to make your life easy. That is the end of our discussion on capital budgeting and investing. Any questions? Capital budgeting and investing. I do okay. All got it.
Yeah, I'm gonna go through the slides before I do my homework or the quiz, but
Right idea. Good idea. Very good. Okay, let's talk about the final exam. Can't believe we're talking about the final exam, but it is the end of the semester. So I guess we're talking about the final exam. Let me get into my student view. Hold on just a second. I'll show you the classroom as a student. This is the way that you would see it. And let's talk about this final exam thing. Module 4, week 8. The exam due date might change depending on the schedule from the university. They haven't quite told me what that is, but just plan on December 11th having it done, which I think is the absolute last day of the semester, if I'm not mistaken. All of your work, if you're late with anything, everything must be submitted by this Sunday night, December 4th. Okay? By December 4th, you must have any of your late work has got to be done, including chapter 26 that we just talked about. You cannot take the final exam until all of your work is done. Very simple. Okay? Make sure you submit all your late work by this Sunday night, period. I cannot and will not accept anything past this Sunday night. Clear? Okay. Final exam. It's worth 20% of your grade. It's a big deal. Okay? I want you to take your time with this exam. It is not timed. You can only take it once. Okay, you only get one shot at this, but it is not timed. You can save your answers and come back to it by clicking Save and Close. Click Save and Close. You can come back to it later. So if you want to start a little bit now, you're like, oh, okay, I feel pretty good about this. I can start it now by selecting your responses. Come back to it later, click Save and Close. No problem. You can do that. Once you click Submit, that's it. Done. Submit. Once you click Submit, that's it. Okay? Then it comes to me, and that's it. It's done. But once you click Submit, it's gone. Right. So let's take a look. The final exam covers everything from the midterm forward. Remember, the midterm covered, I think it was chapters 16 to 21. That means the final exam is going to cover chapters 22, 23, 24, 25, and 26. Okay, chapters 22, 23, 24, 25, 26 on the final exam. There are 20 questions covering 5 chapters. We can figure out how many questions per chapter, yeah? Probably 4 questions per chapter, roughly. Let's take a look at the exam. 20 questions, a mix of true, false, multiple choice. Coming down, you'll notice that the majority of these questions are definition based. The majority of these questions are definition based. You'll also notice the flow of the questions. Okay, take a look. These first few questions are talking about budgeting. Isn't that interesting? Because wasn't there a chapter on budgeting? Yeah, there was. Okay. It's a good chance that those questions came from that chapter. Interesting. Question 3, production budgets. That would be the chapter on budgeting, if I'm not mistaken. See where we're going with this. Which department is often responsible for the direct materials price variance? Oh, remember that conversation, price variance. Price variance. And it's talking about direct materials. Remember? Question 5 is talking about standard costs. Standard costs. There's a whole discussion on it. Was that last week or the week before? I think it was the week before. Standard cost. Direct labor cost variance. There's that word again, cost variance. This is a definition, isn't it? Question 7. Standard costs are preset costs for delivering a product or service under normal conditions. This is a definition. Standard costs, preset, mostly, under normal conditions. Sounds accurate to me. I'll make you make that decision. A unit of business that generates revenue and incurs costs is called a, remember we talked about those centers, all the different responsibility centers. Remember we talked about those things. We did. Yeah. That's that chapter on responsibility accounting. Remember? Accounting system that is set up to control costs and evaluate managers' performance by assigning costs to the managers responsible for controlling them is called it's an interesting one. I think that came from the responsibility accounting chapter. Question 10, profit center managers. That's the same chapter, yeah? Question 11, departmental contribution to overhead. It's the same as gross profit generated by that department. That looks like a definition question to me. Question 12, the potential benefits lost by taking specific action when 2 or more alternative choices are available. We talked about that last week. I know we did. It was on that question came from the PowerPoint slides. Pretty darn sure. From last week. Question 13. Determine a product's selling price based off of the total cost method. We talked about that last week. Opportunity costs are the additional or incremental revenues generated by selecting a certain course of action. Think about that one carefully. Talked about that last week. Costs already incurred in manufacturing the units of product that do not meet quality standards are relevant costs in a scrap or rework decision. I know we talked about that last week. Question 16. I bet you can guess what chapter this came from. We probably just talked about it. The capital budgeting process. Chapter 26 was about capital budgeting. Involves all of the following except. Right? Question 17. Guess what? Same chapter, chapter 26. We just talked about this. Which one of the following methods considers the time value of money in evaluating alternative capital expenditures? Considers the time value of money. Sounds like an interesting question to me. Right. Question 18. The process of analyzing alternative long-term investments and deciding which assets to acquire is known as, man, we just talked about that. Chapter 26. Question 19, chapter 26. Question 20, chapter 26. Okay. You see they go in order, right? There's 20 questions based on 5 chapters. That means that there's about 4 questions per chapter. Okay? They pretty much go in order. 22, 23, 24, 25, 26. Those 5 chapters, they go in order. There's 4 questions per chapter. You can easily identify which questions are from which chapter, right? So there's no reason for you not to ace this exam. The only reason you don't ace this exam is because you rushed it. Don't rush it. You got time, okay? You got 11 days to get this done. 12 days, technically. So I want you to start it now, if you want. Remember, you can save and close. Come back to it later. You know, do one question at a time. Take your time with each question. Read the questions carefully. Read them very, very carefully. Okay. They're all pretty much definition based. Some of them are a little tricky, sure. But I promise you, if you take your time, you know what the flow is. Chapter 22, first 4 questions. Chapter 23, next 4 questions. Chapter 24, next 4 questions. 25, 26, etc. I promise you, you'll be all right. Just review the PowerPoint presentation slides. Review the textbook, your notes. You might even want to try some of the exercises, just so you totally understand all the content. And just go in order. Okay, you go in order, I promise you, you'll do well. Sound good? Is that fair? Did I do okay in reviewing the exam?
Yeah, I think it should be fine. It doesn't seem intimidating.
It's not. You'll be okay. It's not intimidating. You'll be all right. Good. Okay. Are there any final questions, comments, or concerns about this course? Anything at all? Good. Okay. Remember, you can always email me, call me, set up office hours. I'm still here for you. This is our last session together. You should hopefully be receiving a survey from the university about this course. Please take the survey. It helps me. Okay. That tells me what I do good, what I don't do good, what I can improve on. Okay. Very, very important that you complete that survey. Please do it. Meanwhile, if you need anything, email me, call me, set up office hours. Oh, and remember what I told you at the beginning of the course. Some weeks ago, I said, I want you to not just think of me as your professor, but think of me as your mentor. Okay? I want you to feel free to reach out to me, even after this class. Say, oh, Dr. B might be a good person to ask that question to, or if you're thinking about a career in finance or accounting or whatever, or you need something else, please feel free to reach out to me, okay? I want you to remember that I'm here for you, not just for this course, but also beyond this course. So, it's been an absolute honor and a pleasure to be your professor over these past 7 weeks. I really enjoy what I do, as you know, and I've enjoyed having you. You've all done very, very well in this course so far. I wish you the best on the final exam. I know you'll do well. I'm not worried about it. I wish you the best with life and with the rest of your degree. Again, if you ever need anything, I'm here for you. So please reach out. Thank you all so much for your time. It's been a pleasure. I wish you the best. Thank you so much. Please stay safe. Wash your hands. Do the right things. And I'll see you at graduation. Okay? If you're graduating this December or this spring, I'll see you there. I'll see you in May at the ceremony. Okay? Stop and say hi.
Can't wait to see you, Professor.
Wait to see you too, Asia. I'm looking forward to it. Thank you so much. Take care, y'all. It's been an absolute pleasure. Happy holidays, Merry Christmas, all that fun stuff.
Bye-bye.
Wish you
Happy holidays.
take care, y'all. Thank you so
Thank
much.
you. Thank you, Professor. Take care.
Thank you, Charity. You too. Bye bye.